Take a listen to what Tom Lee just said yesterday.
Now, reaction and maybe what to do. Tom Lee and Joe. Tom, I'll start with you. Honestly, I don't think enough attention's to this capital gains proposal we got last night. I think that might be sprinkled in here. But anyway, GDP's getting all the attention. Steve laid it out nicely. What is your take?
I agree with Steve's point. You know, the GDP number did catch people off guard. The core price index being basically a hot number, 2.9 year over year. But it is going to come down to the revisions, which everyone expects. I think there's also now a disconnect between the CPI numbers we're seeing and like what we hear from companies or even, consumer surveys. I mean, for instance, in just this first quarter earnings season, the mentions of inflation as a problem is now at the lowest level since the first quarter of 2021. So it makes me wonder, how is inflation accelerating when fewer companies are even mentioning it as a problem in the first quarter? I think that there are catalysts, in the next couple of weeks. I mean, the first one, of course, is tomorrow to see really what March inflation looks like. But I think the earnings backdrop has actually been very supportive. 80% of companies are beating. So as painful as the last couple of days have been, and really the last couple of weeks, I actually think it's the risk reward's positive here.
Right after he said markets are going higher, Microsoft comes out, beats on earnings. That stock was up over 5% in after hours trading yesterday. It is still up over 2% today, which is a strong day. And, what you've seen prior to Microsoft earnings was a pretty strong move as well. So also take that into consideration. Google is the real winner. Google is up over 10% today after really they announced a surprise dividend on top of good earnings. So the big question really is, where are we going next for markets? We can look back, at yesterday and say, oh, I should have done this or I should have done that. Forget that. Where are we going next? And how can we best position for it? That's what I will go over here in this video. We did have some data that came out today, and we're going to have a lot of different events coming next week. More big tech earnings. You're going to have the Fed next week, and I'm going to share my perspective on both of these events for you in this video. So we did have some data that came out this morning. You had core PCE month over month. That came in line with expectations of 0.3%. That was also the expectation, so not a real shocker there. Personal income month over month came in at 0.5%. That was also the estimate. Personal spending came in higher than expected. The estimate was 0.6%. You actually came in at 0.8%, so a little bit higher there, which after all, again, the bull thesis right now for markets is it doesn't matter what the Fed does. People are spending money. They are employed, and that's going to drive S&P 500 earnings growth this year. So really, if the economy gets worse from here, if people stop spending money, that could destroy the bull thesis for stocks. So anything that really solidifies that, the earnings are probably going to continue to be and come in better than expected, that is, I guess, as Tom Lee would say, a valuation support for the markets. Now, you do also get the PCE price index month over month and year over year. So month over month, not your core, just your headline, came in also 0.3% month over month. That was in line with the estimate. And year over year came in at 2.7%. Last month, it was 2.5%. The estimate was 2.6%. So you did come in a little bit higher on a year over year basis, but markets, they're always going to care more about month over month than year over year, right? Because, that doesn't really matter too much what the number was a year ago and what it is today. Okay, it really depends where the trend is. And the trend for inflation recently is definitely higher, but this number coming in line with expectations is showing that maybe inflation's not running off. It's not enough for the Fed to, do a victory lap, but it's maybe not enough at the same time to say inflation is running off from here and this could be the second wave. I think we need more data. I think we need more time to figure that out. And after all, I guess, if you want to just say it how it is, 0.3% for the month of March, month over month. That's very high still. I mean, 0.3% on a 12-month annualized basis is 3.6%. That is well higher than the 2% Fed target. While everyone in the markets tried to just laugh off or walk off, if you will, January, February inflation numbers, March is also proving to be pretty high as well. So it definitely could have been worse, but it wasn't bad at the same time compared to expectations. Now, looking ahead to next week, we'll talk about this a little bit more over this weekend, so stay tuned to the channel. If you have not already, hit that like button and subscribe to the channel, especially if you love to hear babies scream in the background. So on Wednesday is going to be the first day of big data and big events for markets coming next week. That is going to be on May 1st, so you might as well start your May off with a bang. You do have ISM manufacturing PMI that will come out at 10 o'clock in the morning, and JOLTS job openings that will also come out at 10 o'clock in the morning. But the big story will be the Fed. The Fed is at 2 p.m. as they always are, Eastern Standard Time. And then the conference from Jerome Powell is at 2:30 p.m. Eastern Standard Time. Now, I will say heading into that Fed meeting next Wednesday, the markets are pricing in pretty hawkish Fed. Okay, if we take a look at how many cuts we're expecting in 2024, and we do this, and you guys can do this for yourselves, investing.com/Fed rate monitor tool, and pull this up and go to the December 18th, 2024 contract and see what the odds are. And this is basically telling you how many cuts you're expecting for the full year of 2024, including this December 18th meeting. And currently, you're only pricing in one cut, with 38.5% odds. There's 17.6% odds of no cuts and almost 31% odds of 2 cuts. Now, I don't think the Fed is going to go from 3 or 2 down to necessarily 1. I don't think they want to box themselves in, especially following the GDP data that we got yesterday that showed the economy is not as strong as people thought. The estimates for quarter-over-quarter GDP were 2.5%, 2.5%. That number came in at 1.6%. That was well lower than what Wall Street thought it was going to be. And I don't think the Fed wants to box themselves into a corner in case the economy does get weaker from here. And I think that's important to consider. So if we're heading into next week expecting 1 cut, I'm sure the Fed's still going to say, hey, we expect a cut this year. If they don't say that, then you're in for a problem. If the Fed comes out and they say, oh, crap, yeah, maybe we're not going to cut rates this year. In fact, maybe we're looking at hiking rates if the data continues to come in this hot. Yeah, then you're going to have a big problem on your hands. But I do think on face value, you are pricing in a pretty hawkish Fed, a Fed that's really not going to be cutting rates in any kind of substantial way in 2024. And we are pricing in the first cut for September. So the only cut is priced in September 18th, 2024. You can see here 45.6% odds and a 38.8% odds of no cut by September. So I think the next couple of data points could really start to solidify, 1 cut, 2 cuts, or no cuts for 2024. And the Fed next week will definitely do that as well. And I think another big factor of next week is the balance sheet reduction. The Fed made it pretty clear they're going to be talking about that a lot at this upcoming meeting. And there may be a change in the way the Fed is rolling off their balance sheet coming next week. And as you guys know, when the Fed does add to their balance sheet, that is very accommodative. When the Fed reduces their balance sheet, that adds more supply to the bond market. And if you take a look at TLT, I mean, the Fed adding more supply, the Treasury adding more supply by selling bonds to fund the government that's spending like they're drunk, it's had a very downward effect on bonds. Now, when TLT, this bond ETF, just to show you kind of pricing, when this falls, it does a couple different things. When this falls, rates go higher, right? Because the yield you actually get on a bond is fixed. It doesn't change. but the price of the bond changes, right? So if the bond drops, the yield goes higher, just like a dividend stock. If you buy a $100 dividend stock that pays you $5 a year, if you buy a $100 dividend stock that pays you $5 a year, great, that's 5%. If everyone wants to own that dividend stock, and that would be representing TLT going higher, and you're still getting paid $5, well, let's say it goes to $200 per share, then you're getting paid 2.5% if you're buying the stock at $200. Vice versa, if your company's still offering the $5 dividend, but nobody wants to own that dividend stock, and let's say it goes to 50, then you're getting paid 10%, and that's would represent the bonds falling. So nobody really wants to own the bonds right now, and bonds are falling, and thus yields are rising. Part of that you could contribute to the Fed, and the Fed is a big reason why 10-year Treasury yields currently sitting at almost 5%. So I imagine you would have a fall on Treasury yields, and that could be positive for stocks as well coming next week. Now, I don't know if they're going to make an action next week. They may just announce it or talk about it, but it is possible that they actually do announce what their plan is going to be for the balance sheet reduction. Coming next week, you are really going to get into the heart of earnings season. Monday pre-market, you will have SoFi, Domino's, On Semi, Philips, Jinko Solar. Monday after hours, Paramount, Transocean, NXP, Logitech, Arch, Chegg. Tuesday pre-market, PayPal, Eli Lilly, 3M, McDonald's, Coca-Cola. Tuesday after hours, Amazon, AMD, Supermicro, Starbucks, Pinterest, Root, Lemonade, Caesars. Wednesday pre-market, Pfizer, CVS Health, Barracks, MasterCard, Norwegian Cruise Line, and Kraft Heinz. Wednesday after hours, Qualcomm, Devon, Energy, Paycom, Carvana, Etsy, Fastly, so many different companies. Thursday, Novo Nordisk, Peloton, Moderna, Penn National Gaming, ConocoPhillips, Cigna, and Wayfair. Thursday after hours, really your second big tech stock of this upcoming week, Apple. I think that one could get very interesting. Coinbase, Block, DraftKings, Cloudflare, Bill.com, Fortinet, Amgen, Booking Holdings, and Expedia. And then Friday pre-market, you have Hershey's, Fubo, XPO, Logistics. Now, big story of next week is clearly going to be Apple and Amazon. Now, I think Apple is the one that's a little bit more vulnerable here. We already know the Huawei phone in China is starting to eat into Apple's market share, whereas Apple hasn't really had a lot of competition in China for a long time in terms of, that premium smartphone market. And it looks like they are starting to. Apple shipments to China were down about 19% in the last quarter. So that's probably going to hurt some of their numbers. And without China continuing to grow and Apple continuing to dominate that market, I think it becomes a lot harder to, one, forecast for Apple, but hold the current valuations that Apple has seen. Without Huawei taking, parts of Apple's market share, Apple's still been in a very rough place. Last quarter was the first quarter they went positive on revenue growth on a year-over-year basis because the comps just got easier. Apple really hasn't grown revenue in years, and I think that becomes more challenging given what I just said. I think Amazon's probably gonna raise. Wouldn't surprise me if they offered some kind of small dividend as well. Supermicro and On Semi could get pretty interesting as well. Supermicro, the reason that kind of catapulted, I guess, markets lower was Supermicro. They typically come out and they pre-announce their earnings, and that was last week, and they did not do that. Okay. The first time since the beginning of 2022, they have not come out and said, hey, we're going to report earnings on this day, and these are the numbers that we're going to report. Basically, like, we just beat big time. Maybe you're not going to get a beat from Supermicro. And that had a lot of people concerned, or Supermicro's doing this to pull your leg. And maybe they do beat. And maybe they just want to stop pre-announcing. We'll see. And obviously you have AMD as well, which will both of these affect Nvidia. And that's going to be a big story or theme of next week as well. Another big story today is the dollar is up about 0.5%. Typically when the dollar goes up, stocks go down. The S&P and NASDAQ typically tend to inversely correlate the dollar. That hasn't happened as much in 2024, granted, but the Japanese yen is the one that is really falling today and weakening, and that's because the Bank of Japan had their BOJ, like Fed meeting yesterday, and the Bank of Japan did not raise rates. They were not expected to raise rates, but the Bank of Japan basically said, hey, we'll get involved if we need to, but right now it's not really adding to inflationary pressures here in Japan, so we're just going to leave it. And that's why the Japanese yen has been falling so much. And for Japan being the third largest economy in the world, it's a little bit problematic. Not the end of the world. It's not going to cause a crash for our markets, but it is something a lot more people are starting to talk about today, because the Japanese yen weakening to the degree that it is pushing up the US dollar. And when the dollar rises, that basically means if you're a company like Tesla or Netflix or Apple, any of your big companies that do business in foreign currencies, they take in those foreign currencies, convert that to a strong dollar, they get less dollars. If you have a weak dollar and you're taking in strong foreign currencies, well, the strong foreign currencies convert to more US dollars. So it's called an FX headwind. If you see that on earnings calls, that's what it is. And it is problematic when the dollar rises for company earnings. As you can see today, the NASDAQ is up about 1.8%. And a lot of this, again, comes down to Microsoft and Google having good earnings. Without Microsoft and Google having good earnings, markets would be down a lot right now. But they had good earnings. So you're above your 100-day moving average. You actually gapped up just a little bit above that 100-day moving average. And you're actually butting up here to your 20-day moving average. Now, it's undecided, I guess, so far, if we're going to find resistance here. If we do find resistance, then we maybe just trade between the 50 and 20-day moving average for a period of time. If we do go higher, then pretty shortly after breaking the 20-day moving average, you're also going to test the 50-day moving average at about 436.46. Now, I think given the backdrop that I just mentioned, earnings are coming in good. Some companies are kind of disappointing on that guidance. I don't think next week is going to be the week in which earnings ruins everything. Apple's clearly going to be problematic, but by the time we get Apple next Thursday, you're going to have Amazon, you're going to have Microsoft, you're going to have Google, Tesla, Netflix, all these other guys reporting earnings with their own stories. I don't think Apple, even if theirs is bad, and their story is seemingly pretty bad right now, I don't think that's going to derail the markets. Okay. Maybe so. Maybe I'm wrong. Maybe Apple does derail the markets. But from that perspective, I think you're fine as far as earnings. Because you have Microsoft, because you have Google, now Supermicro Computer, SMCI, AMD, that could be a bigger problem for the markets if they come out with bad numbers. But what you're hearing so far is things are okay. Right? Things are not terrible. Some of that fear about the AI semiconductor slowdown has started to subside a little bit. So we'll see how those numbers do come out. But overall, I'm not thinking next week's going to be necessarily a problem as far as earnings. The Fed, I think the markets are priced well for a hawkish Fed, and I think the Fed's not going to be as hawkish as what the markets are currently pricing in. So I think that could be an upside catalyst. I also think the reduction of the balance sheet runoff, or the amount of, balance sheet runoff they're doing, reducing that, is probably going to be a positive as well for stocks. The issue I have is how expensive the markets are. I think the markets have kind of come to terms and said, stocks are pretty expensive here. We're not getting any deals. So I struggle with saying the NASDAQ or the S&P is going to break out or rally from here. After all, you did have a over 8% correction from this was March 21st through April 19th. Like, this was a sizable drawdown. Let's not forget that. but you're still super expensive. So I think the backdrop for markets does look good right now, but I don't know how high we go. But if I were to, make a bet here, it would be that markets are going higher. Maybe, in fact, next week, and what the Fed says or does, and maybe with earnings, it's actually going to be a better catalyst for small caps. That would make a lot of sense. And when you look at small caps like the Russell 2000 compared to your other indexes like the SPY or triple Qs, you're still quite a ways off of your prior all-time highs. Right now, you are about 20% off of your all-time highs. If there is going to be an area for the markets to rally, it's probably in the small caps. Tom Lee expects small caps could rally 50% this year. If we get anything close to that, I'm sure that rally would have to start somewhat soon. And that is what could happen. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.